When it comes to life insurance policies, there are a lot of logistics that go along with it, especially with policy loans. And it's not something that people come across every single day, so it's something that people have questions about, and rightfully so. Today, we're going to talk about policy loan interest rates and whether the company charges interest in advance or interest in arrears. Hi, I'm Olivia Kirk.
I'm Tim Yurek. We're from Tier 1 Capital, and we're here to show you how to regain control of your money.
For the best advice on controlling your cash flow, be sure to subscribe to our channel and don't forget to hit that bell to be notified when we upload new videos every single week. So let's start off very simply. Let's define what is interest in advance versus interest in arrears.
So interest in arrears means that interest is allowed to accrue on the outstanding loan balance and then is paid at the end of the period. It's literally how banks charge interest on mortgages.
So what would that look like as far as an insurance company and an insurance company charging interest on a loan? Is that the same as, at the end of the policy year? In my experience, most companies send out a bill for that outstanding loan interest at the end of the year.
Yeah, so if you take out a loan, and let's say it was in the middle of the policy year, whatever that loan balance is, let's say you borrow $10,000, you'll pay interest on $10,000 for 6 months. And then at the end of that 6-month period, you'll get a notice for the interest that accrued on that $10,000 loan.
Yep, and with a policy loan, it's simple interest. So it's as simple as saying, okay, if over 12 months, the insurance company is charging us 5.5%, we'll take that $10,000 loan, multiply it by 5.5%. Over the year, it'll cost $550. Over half a year, it'd be $275. And it's as simple as that with that simple interest.
Now, let's take a look at interest in advance. With interest in advance, the insurance company charges all of the interest at the time the loan is taken. So again, if you took a $10,000 loan, and you were paying 5% interest, and the loan was taken in the middle of the policy year, you'll pay 5% interest on the $10,000 for a 6-month period. So on day one, your loan amount is not $10,000, it's $10,000 $250, which is half a year's interest on $10,000 at 5%. At the end of the day, the amount of interest you pay is going to be the same. It doesn't matter if it's in arrears or in advance. It literally is the same at the end of the year. The bottom line is this. It seems like this question has come up quite a bit lately, and the reality is it's really a non-starter. It doesn't matter either way. It's just how your insurance company happens to charge interest. Do they charge it in advance or do they charge it in arrears?
Right. So either way, we're doing the same math. It's just a matter of when the addition is actually added to your loan balance at the end of the day. Now, would this come into effect and make a difference, if any at all, if we're paying back towards the loan principal throughout the year? Will the advance company refund or reduce the amount of interest due at the end of the year the same way, with it being charged in arrears? That calculation is obviously being taken into effect because it happened in the past 6 months, let's say.
That's a great point. So yes, the answer to that question is, let's say you took that $10,000 loan and you were charged $250 prospective 6 months of interest, and you paid the loan off completely in the 3 months from the time you took it, you would get a refund of roughly $125, which was the interest that you were charged on day one of the loan in advance, but you paid the loan off sooner.
Yeah. So at the end of the day, it sounds like it's just a speed bump that people are coming across in a Google search, let's say, that isn't going to make a lot of impact with these financial institutions, right? If you're taking the policy loan, it's the contractual guarantee, it's simple interest. Your interest rate is typically locked in for that full policy year and has the ability to change typically on that policy anniversary, unless it's a fixed interest rate. And that's that. You have all of those benefits to use whether your interest is charged in advance or in arrears.
Exactly. But here's the good news. The good news is you're getting a policy loan. Policy loans are unstructured loans, which means you, the policy owner, are in charge of determining how, when, and actually even if you pay the interest. Now, the interest will always be charged, whether in arrears or whether in advance. The interest will always be charged by the insurance company, but you make the decision as to whether or not you pay the interest, when you pay the interest, and how, or the frequency of how you pay the interest. And that's the key to policy loans, because it puts you in control of the finance function in your life.
Yeah. And of course, we suggest that you do pay that loan interest back because it is being charged. And if you don't pay it, it will accrue right onto your loan and kind of eat into your cash value a little bit. You know, we'd rather pay that so then we're not being charged more interest the following policy year. But if you're in a cash flow pinch, you don't have to at the end of the day, as long as there's enough cash value in the policy to cover that charge.
Exactly. And so at the end of the day, the question is interest charged in arrears versus is interest charged in advance? It's a moot point. It really doesn't matter. But the key is you're in control, and that's the point.
Yeah, exactly. And with that control comes the ability to ebb and flow with your finances. Whether your cash flow is pinched or flush, you have the ability to put more toward your policy loan, take less, take money from your policy loan to cover those outside expenses, and then replenish when you have the ability, which is a huge deal, especially these days when the word recession is being thrown around. Whether you're a family or a business owner, access to cash is never a bad thing.
Exactly. So it's much to do about nothing, but at the end of the day, it's really good that you're considering policy loans because they could help you bridge the gap from a cash flow perspective.
Exactly. If you'd like to learn more about how to put this concept to use for your business, your family, your specific situation, be sure to visit our website at tier1capital.com to schedule your free strategy session today. We'll do a breakdown of your specific situation and be able to answer more specific questions that you may have regarding policy loans and how to put them to work in your situation. If you like this video, be sure to give us a thumbs up and check out these two. We picked them out special for you.
Thanks so much for watching our video. And remember, it's not how much money you make.
It's how much money you keep that really matters. We'll see you in the next one.